Hello traders. This is the last video of this series. It's been fun. I've actually got to review some stuff, and they say you don't really understand stuff till you have to teach it. A lot of stuff I haven't actually explained to anyone. So it's been fun. It's helped me out, and I hope it's helped you out. To finish, I just kind of want to go over some of the stuff that it's like the personality traits it takes to become a good trader. My favorite mentor, Dwayne Archer, always hammered down, trading strategies vary between good traders, but the things that are the same is most traders have, a good psychology, a good sense of process, good money management. We already talked about process. The thing that I kind of didn't hammer on was the trading journal. I kind of told you that I keep track of all my trades. The other thing, though, with those, on top of it, is keep track of your emotions and your thoughts. I know it sounds funny, but if you're in a bad mood, or you're sick, or you're tired, or you're drunk, don't drink and trade. If you can't drive a car, you can't trade. But, hopefully that's pretty obvious to most of you, but I know some people that don't seem to get that. But anyway. But even if you're kind of in a bad mood, you're angry or something like that, you're going to make rash decisions, and it might affect your trading. Or if you're sad, so, write down your emotions so you slowly become aware of them, and then go back when you do the process and you're now analyzing your trade, see if there's a pattern like, oh, well, man, I was feeling depressed all these times, or sad or something, and maybe I shouldn't trade when I'm sad because I keep losing when I'm like this. It's a good habit to get on. Other things for psychology, the two big ones are obviously fear and greed. I talked about risk aversion in the paper. I read this, it was, I can't remember what school did it, but it's kind of a new thing in economic theory where they're relating, it always used to, the idea was that people act as complete rational beings, and they always will do the thing that will give them the best economic outcome. Completely rational beings. This paper kind of says, you have like kind of the reverse of that, or I won't say reverse, maybe just there's a different perception on it, and I agree with it more. It's called, and what it related to was people are naturally risk adverse. They don't like to take risk when it's in regards to money. But what happens is when people start making money, they get so confident, or they get greedy, that they're like, oh, I can take on the world, and they risk more and more and more, and pretty soon probability is going to come out to play, because there's no trader that's 100% successful. None. I mean, if you're 75%, that's crazy top, like 5% of traders are 75% successful. Let's say I'm about 65 to 75, depending on the month. It varies for me. But anyway, you risk more, but pretty soon, even if you're doing great, you're gonna hit that probability. You're gonna lose. So when you lose, you're gonna lose much, much more than you would have originally, and you might even go back further than what you've been winning. That's a horrible habit to get into. Don't do that. Don't, one rule of thumb to follow when coming to risk is don't ever risk more than 2% on a single trade of your account. So if you have an account balance of $20,000, you should not be risking more than $400 on an individual trade. Your stop loss should stop at $400. That's 40 pips for one lot. And also, this relates to correlation too. Be careful. If you like, a good thing to do might be able to get a good correlation software to see how correlated pair is. A lot of times, like the euro is highly correlated with the pound or the Australian dollar, and So if you're taking a trade on the pound and then you see another trade on the euro, make sure that's not this. They don't look exactly the same, because correlate if they're like correlated to like a +1, like highly almost doing the exact same thing, you know, you might only want to take one lot out on one pair, because if the trade goes wrong, chances are it's going to go wrong for both pairs. So that's my advice for that. Don't risk too much. This also goes into the King Kong syndrome I mentioned in the paper, where you get so high and mighty on yourself that you think you can apply, your King Kong. You climb the Empire State Building, but King Kong got shot down. No, same thing usually will happen to you. The reverse of this is the fear. This goes right back to the paper on risk aversion. Is when people start losing, they have this sense of urgency to make it all back, so they risk more. They're like, oh yes, 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 I can make it back. I can make it back. As gamblers, like that's why gamblers have horrible addictions to gambling. It's because when they lose, they think they can just make it back by risking more. Don't do that either. That's the worst, and this, the biggest thing is moving your stops. A lot of people will see the trade's not going in their direction, and they'll want to move their stops lower, because they'll think, oh, it's got to bounce eventually, and they keep losing it and moving, and pretty soon they're like negative 200 pips. Be careful of that, I've caught myself doing it a couple times, actually, and I knew better originally, I got taught not to do it. So just be very, very wary of it. Okay, be conscious of it. Some other things related to psychology: get on a schedule. Wake up if you're going to trade a certain session. Get enough sleep, 8 hours of sleep. Wake up. Good nutrition, exercise. There's tons of paper on sports nutrition and psychological performance. Read some papers on that. Nutrition affects your thinking a lot. If you're eating donuts all day and drinking caffeine, you're just going to might give you a burst of energy for a minute, but you're just going to be cloudy most of the day. And, a lot of times when you're starting out trading especially, you got to be able to stare at a chart for a few hours to kind of see what's going on and make those hypotheses and get your process down and just generally get the feel of things. So, good routines are good. Good exercise, good sleep, good nutrition. I think that's all I'm going to talk about for psychology. We'll move on to money management. To start with, I would just start with a good risk-reward ratio. Now, what is a good risk-reward ratio? I'd say 2 to 1. So what does that mean? That means that if you're looking to make 20 pips, you're only risking 10 pips, okay? Or if you're looking to make 40 pips on the trade, and this is calculating, like you're looking, okay, there's a stop, there's a big support resistance level right there in the opposite direction, or there's a Fibonacci level in the opposite direction right there, and I better take profit before it gets there. Then you're only looking to risk 20 pips if it's 40 pips, okay? This is a good place to start, because what that means is that even if you lose twice as much as you're winning, you're going to break even. Right? So let's say, for instance, on this 20 to 10 thing, you're looking to win 20 pips. Even if you only won once, that's plus 20 pips, right? But you lost twice, so that's negative 20 pips, because your stop loss was at 10 pips, so you've lost twice. That equals 0, which doesn't sound like much, but you gotta, as soon as you break even enough, you're gonna start going ahead. Your original goal should be to break even. Now let me do the expected value calculation, so maybe some of you are interested in that. So let's say that you're looking to win 40 pips, right? This is how I do it. It's an experimental thing. Now let's say that you know from your trading notebook that this type of trade setup has a 75% chance of being successful. So you take that and you times it by the 40 pips, and then you subtract. And this is what experimental part is, because you're looking to have the best stop. The furthest stop away, yes, maybe the higher chance of success, but you still want The only way you're going to do this if you know statistically that this has a certain amount of statistical chance of success. So what you do is you first take the percent chance, which is 75, and you change that to decimal 0.75. And that equals, let me get my calculator out real quick. So 0.75 times 40 equals 30. And then you subtract. So then you have a 0.25 chance of not succeeding. And this is where experimental part chance comes in. So basically, just go 0.25, let's say, times 40 equals 10. So you're still positive right there, right? Let's go 0.25 times 60. 15. 0.25 times 80. 20. And that's where I would probably stop, right? Because that's like saying that you have an 80 pip stop loss. So that 0.25 times 80 is 20, right? So that gives you a 10. So that's a positive EV. But just for experimental purposes, see how far we could go. Let's go with 90. Go 90 times 0.25 equals 22.5. 100. So 100 is going to be 25. So you know you could go, let's try 125 times 0.25 equals 120 times 0.25 equals, so 30. So you go all the way up to 120 pip stop loss for a 40 pip win, because you're going to, that's a break even point, actually. At that point in time, you're going to break even. So basically what you're looking for is, you're always looking for a positive expected value doing these calculations. So basically you just take the statistical chance that you're going to win, and by that, and how much you're going to win by doing that. And you times those two together, and you take that value, and then you subtract the statistical chance by X, which is your stop loss. So, obviously the higher the expected value, the better chance of success is. That's what I use in my calculation. It works pretty well for me. I think I'm going to close out that, that's becoming a trading superhero, and that's what I labeled that. It's like take on these traits, and you will be successful. Your trading strategy might vary from mine. You might have completely different. You might use clouds or Gone or something like that, or Elliott. There's a lot of different things out there. Harmonics. There's so much out there. But what needs to stay into consideration is money management, process, and psychology. I think those are the most important things and you should focus on those at first before get a simple strategy. Okay, I'm in a rangy market, I'm looking to trade the Fibonacci level at this level with candlesticks. Start with that, Then you use the process to experiment and see where you need to tweak it, and at the same time you're like, I'm going to make sure I get 8 hours of sleep, and I'm going to be there 15, 30 minutes before the London session opens or the New York session opens, and I'm going to make sure I'm in a good mood, I'm going to exercise, and when I'm doing my trade, I'm not going to move the stop loss up, I'm not going to be greedy, I'm going to watch my fear and my greed, keep those traits, and I wish you the best of luck. It's been fun.